Receivable accounts are crucial for a company as it demonstrates the amount owed by customers and other entities for the supply of their goods or services. It is vital that companies also keep track of the receivables that are not being collected. Common terms that suggest that companies utilize this account is when they claim to sell their product or do the service on account, resulting in an increase on accounts receivable. The receivable account would then decrease once cash is collected. These accounts are deemed as assets as they are expected to be collected within a month. At times, companies will not obtain the receivables due to a number of reasons. This could include returning the product because they are not needed, they are not what they expected, or were unhappy with the product. If this occurs, it causes a decrease in the receivable account and an increase on the contra asset account, sales returns, and allowance. Other reasons could include customers not paying their bills, experiencing financial hardships, relocating without paying, or refusing to pay. If this occurs, companies must record what they expect to collect using a net realizable value from its total receivables. We refer to this amount estimated not to be collected as allowance and is recorded as bad debt expense. This estimated number can be calculated using two different methods. The direct write-off method is used when the company claims it to be uncollected and writes it off its records, and thus recorded for the same amount of the receivable. This method, however, violates the matching principle and is prohibited by the general accepting accounting principles. It may be used if it's claimed to be immaterial, not affecting accounting decisions significantly. The allowance method uses two entries to record the bad debt expense, requiring the company to set an allowance for uncollectible receivables. Similar to the sale returns allowance account, the company must create a contract asset account, the allowance for doubtful debts account. This represents the amount of uncollectible receivables and is calculated by past experiences using percentages. Using either the percentage of sales approach, which multiplies the total assets by a percentage amount that the company deems to be uncollectible, or the percentage of receivables approach, which is calculated by first calculating the allowance for bad debts given by multiplying accounts receivables by a given percentage, then adjusting the allowance account to the estimated account balance, which represents the bad debt expense. Thus, these accounts help keep track of the receivables that are not being received or returned and are closed at the end of each period.
Created using Powtoon.